Hello everyone, welcome back to my channel Risk Modeling Hub, a trusted source for practical credit risk knowledge. I'm excited to bring you video 5 of our 100 video ECL Mastery series about the EAD. So if you are preparing for credit risk interviews at banks, big four firms or regulatory bodies, this video will give you the deep practical understanding of EAD that separates junior candidates from senior practitioners. We are not just covering the textbook definitions today, we are diving into the actual modeling methodologies used in the industry, the challenges practitioners face, and the insights that will make you stand out in any interview. By the end of this video, you will understand not just what EDA is, but how banks actually model it using the CCF regression, EADF approaches, and advanced techniques like survival models. You will know how to handle the small denominator problem and understand the crucial differences between the IFRS 9 and Basel EAD requirements. But before we deep dive into the EAD, let's quickly position ourselves within our ECL mastery journey. In video 1 and 2, we established the fundamental ECL framework. In videos 3 and 4, we explored the PD and LGD in detail. You can refer that. And today we'll complete the Trinity with the EAD. So I hope that you remember our core ECL formula, that ECL is equal to PD into LGD into EAD. So here the EAD represents the exposure amount the bank faces at the moment of default. So while this sounds simple, EAD is actually the most behaviorally complex component of ECL. But why? Because unlike PD, which is about the likelihood of default, EAD is about predicting the borrower behavior leading up to default, and this behavior varies dramatically by product type and economic conditions. So let's start with the fundamental question. What exactly is EAD? Exposure at default is the expected outstanding amount at the time a borrower defaults. So for a simple term loan, this might seem straightforward. It's the remaining principal balance. But for revolving facilities like credit cards or corporate credit lines, it's far more complex. The basic EAD formula for revolving facilities is EAD equal to current drawn balance plus CCF into the undrawn amount. Here CCF is the credit conversion factor, the percentage of currently undrawn credit that we expect the borrower to utilize before defaulting. But here's the critical insight that many miss. Borrowers approaching financial distress don't behave randomly. They systematically draw down the available credit as a survival mechanism. And this is called the adverse selection behavior. And it's why simply using the today's balance as EAD that will consistently underestimate your true exposure. A common interview question mostly asked is, how does EAD differ between the IFRS 9 and Basel? And this isn't just academic, these differences drive the real modeling decisions. So under the Basel IRB approaches, EAD is calibrated on a through the cycle basis for regulatory capital with 12-month horizon focus, and here the foundation IRB uses prescribed CCF values. The advanced IRB allows the internal models with regulatory floors. But under the IFRS 9, point-in-time forward-looking estimates is required, and lifetime ECL for stage 2 requires the EAD projections over the entire facility life. It must incorporate the macroeconomic scenarios and the behavioral life assumptions needed for the revolving facilities. So what's the practical implication here? That your IFRS 9 EAD model must be more dynamic and scenario sensitive than your Basel model. Now let's talk about some challenges based on product specific. EAD modeling complexity varies dramatically by product type. And let me walk you through the key categories. Term loans and mortgages. It's relatively straightforward. EAD follows the amortization schedule adjusted for prepayment behavior. Your main modeling challenge is predicting the constant prepayment rates, that is the CPR, based on the interest rate environments and borrower characteristics. Next is the revolving credit facilities. This is where the EAD modeling gets sophisticated. Credit cards, overdrafts, and corporate revolving lines have no fixed repayment schedule. Borrowers can draw, repay, and draw again. Empirically, we observe that borrowers approaching default tend to maximize their utilization. They are using credit as a financial lifeline. Committed versus uncommitted facilities. Under Basel, some uncommitted facilities can receive zero CCF. But under IFRS 9, you must consider the economic reality. If the bank is unlikely to cancel the facility in practice, you need to model the expected drawdown even for technically uncommitted lines. Now let's talk about the CCF modeling, the industry standard approach. This approach, the industry one, uses the historical cohort analysis. For this, first is the reference date selection, typically 12 months before the default, Basel standard. Cohort construction, taking all the facilities active at the reference date. Default tracking, follow these facilities forward to identify which ones default. CCF calculation, for defaulted facilities, calculate the CCF, which is the limit at the reference minus the balance at the reference over the EAD at the time of default minus balance at the reference point. So here the key insight is that CCF varies systematically with observable risk factors: current utilization rate, product type, borrower risk grade, and macroeconomic conditions. We captured these relationships using the regression models like the typically OLS, Tobit, or beta regression depending upon the data characteristics. And here's a critical technical challenge that separates the experienced modelers from the beginners: the small denominator problem. So when calculating the CCF, the denominator is the undrawn amount. And what happens when a borrower is already at 95% utilization? The undrawn amount becomes tiny, and small changes in balance create enormous CCF swings. So for example, if a customer has a limit of 1000 with 950 drawn amount, and here the 50 is the undrawn amount, and they incur a 25 of in fees before default out of that 50, so their CCF jumps to, or their CCF becomes 50% here because 25 is already drawn from that 50 undrawn amount. But if they incur, let's say 50 in total of that fees, the CCF jumps to 100%, and this mathematical instability ruins the regression models. So what's the industry solution? We need to use alternative modeling targets for high utilization accounts. So basically, to address this small denominator problem and improve the model performance, banks use several sophisticated approaches. It can be the EADF model, that is the EAD factor model. Here, instead of modeling CCF, we model the total limit of the EAD. And this uses the stable total limit as denominator, avoiding the mathematical instability. Utilization at default model. Here, the model the expected utilization percentage at default directly and then multiply by the limit. Segmented approaches, using the CCF models for the low utilization accounts, EADF for high utilization accounts, creating a hybrid framework. Momentum models. For complex revolving portfolios, model the balance trajectory over time using the transition matrices or survival analysis. Each approach has specific use cases, and sophisticated banks often combine multiple methodologies. Let's talk about the IFRS 9 specific requirements. The IFRS 9 introduces the unique EAD modeling challenges that don't exist under Basel, like the lifetime ECL requirement. For stage 2 assets, you need EAD projections over the entire remaining life of the facility. For a credit card, this might be 5 to 7 years. So you must model not just next year's expected balance, but the entire trajectory. Behavioral life modeling. Credit cards technically have no maturity date, but IFRS 9 requires you to estimate the behavioral life. That is how long you expect the facility to remain active. And this becomes a modeling exercise in itself. Macroeconomic conditioning. Your EAD estimates must react to economic scenarios. In downturns, utilization increases as borrowers draw on the credit for liquidity. Your model must capture this relationship. Forward-looking information. Unlike Basel's through-the-cycle approach, IFRS 9 requires point-in-time estimates, which reflect the current and the expected future conditions. So let's talk about the practical example to understand the EAD calculation. Taking the credit card example. Here, let's say the limit is 5,000 with a current balance of 2,000. That is the 40% of the utilization. Let's say a model is being built and 65% is the model estimated CCF. If you calculate the EAD here with the formula that we have seen before, the EAD is coming out to be 3950. So here if you can notice that EAD is nearly double the current balance, and this is why proper EAD modeling matters. If we consider the corporate revolving facility, if the limit there is 10 millions and from that the current drawn amount is 4 millions, and CCF which is generally defined for each of the grades in the corporates, and here let's say it was 75%. And if you calculate the EAD here, it comes out to be 8.5 million. You can put these values in the formula and calculate. So for capital and provisioning purposes, the bank must consider the exposure of 8.5 millions and not just 4 million that is currently drawn. So that's how we understand what exactly is the importance of EAD. Now from a model validation perspective, and this is crucial for Big Four audit and regulatory review, EAD models require rigorous backtesting. Like the performance metrics, here we track the mean absolute error, the MAE, and root mean squared error, popularly known as RMSE, between the predicted and the actual EAD for recent defaulters. Bias analysis. You should question that are we systematically over or under predicting? And this varies by segment and must be monitored continuously. Discriminatory power. Does the model correctly rank order the facilities by expected drawdown behavior? Stability testing. Model's prediction shouldn't change dramatically over time without corresponding the portfolio changes. Margin of conservatism, MOC. Under Basel Advanced IRB, banks must add explicit conservatism margins to account for the model uncertainty. So, under Basel Advanced IRB, banks must demonstrate rigorous backtesting, address the segmented biases, and apply strict margins of conservatism to account for inherent EAD model uncertainty. Stress testing and economic scenarios. EAD models must support the stress testing and scenario analysis. During economic downturns, EAD typically increases due to businesses drawing on revolving credit lines for liquidity, consumers increasing credit card utilization, reduced voluntary prepayments on term loans. So basically, this creates a triple hit to the ECL. How? That PD is also increasing, LGD is increasing, and EAD is also increasing simultaneously. So this creates a triple hit to the ECL. Your stress testing framework must capture these correlations. And for IFRS 9, this means running your EAD model under base, upside and downside economic scenarios. Then probability weighing the results. And that's how the IFRS 9 works. Now let me share some common pitfalls that I see in model reviews. First is the data quality issues. Incorrect default dates, missing limit information, or system artifacts in the data can severely distort the CCF calculations. Negative CCF treatment. In practice, many defaulted accounts show negative CCF, that is balance decreased before the default. Banks need clear policies on whether to float these at zero or model them explicitly. Segmentation errors. Mixing different product types or utilization bands in a single model reduces the predictive power. Survivorship bias. Only using the accounts that remained active throughout the observation period can bias the results. Regulatory alignment. Ensuring your internal model definitions align with regulatory expectations for default timing and exposure management. Now for interview preparation, here are the critical EAD questions that you will face. What is EAD and how does it differ from current outstanding balance? So the answer is that the EAD is forward-looking, incorporating the expected behavioral changes before default, especially for revolving facilities. How would you handle the small denominator problem in the CCF modeling? Here you should discuss the EADF alternatives, segmentation by utilization, and hybrid modeling approaches. Explain the difference between the IFRS 9 and Basel EAD requirements. Here, the point in time versus through the cycle, lifetime versus 12-month horizons, and macro conditioning requirements should be discussed. How do you validate an EAD model? Here, the backtesting, bias analysis, discriminatory power testing, and stability monitoring should be discussed. Knowing these technical details demonstrate the practical modeling experience. So basically, from a regulatory perspective, EAD models face the intense scrutiny. How? Basel Advanced IRB. Here, it requires regulatory approval, annual validation, and conservative calibration with explicit margins of conservatism. IFRS 9 compliance. Here, the external auditors focus heavily on the reasonableness of behavioral life assumptions and macroeconomic conditioning. Model risk management. EAD models require independent validation, regular performance monitoring, and clear governance framework. From the documentation standards and the best practices, regulators expect comprehensive documentation of model development, validation results, and ongoing performance monitoring. So the key is demonstrating that your EAD estimates are reasonable, conservative where appropriate, and based on robust empirical analysis. And based on my experience in Big Four model validation and model development for banks, here are the industry best practices. The segmentation strategy. Segment by product type and utilization bands rather than using one size fits all the models. Multiple methodologies. Use CCF for low utilization, EADF for high utilization, creating the robust hybrid frameworks. Regular calibration. EAD behavior changes over time due to product evolution and economic cycles. Conservative overlays. When model limitations are known, apply documented management overlays rather than ignoring the issues. Cross-validation. Compare your internal estimates against the external benchmarks and peer bank disclosures where it is available. One should also consider the success metrics like the enhanced differentiation, framework robustness, transparent limitations from the documentation, and benchmarks parity. That is the close alignment with peer banks and top tier validation standards. Let's discuss the macroeconomic integration. For IFRS 9 compliance, your EAD models must integrate the macroeconomic scenarios. Economic drivers like linking the CCF and prepayment rates to GDP growth, unemployment, and interest rates. Scenario generation. Create base, upside, and downside EAD profiles reflecting different economic paths. Probability weighing. Combine scenarios using central bank or internal economic forecast. Dynamic updating. Refresh the scenarios quarterly to reflect changing economic outlook. This forward-looking approach is fundamentally different from the Basel historic calibration and requires more sophisticated modeling infrastructure. So from an implementation perspective, EAD modeling requires robust technology infrastructure. First is the data requirement. Historical account level data with precise default dates, limit changes, and balance histories. Model platforms. Statistical software capable of handling the large datasets and complex regression techniques. Scenario engine. Ability to run models under multiple economic scenarios and combine the results. Monitoring dashboards. That is the real-time tracking of model performance and early warning indicators. Governance workflow. Automated model validation, approval processes, and audit trails. The technology investment is substantial but essential for regulatory compliance and risk management effectiveness. Let me share some real-world implementation challenges you will face. Like the data limitation, many banks lack sufficient default history for robust statistical modeling, especially for low default portfolios. System integration. EAD models must integrate with existing risk systems, often requiring significant IT investments. Model complexity. Balancing the statistical sophistication with model interpretability and regulatory acceptance. Resource constraints. EAD modeling requires specialized quantitative skills that are often in short supply. Regulatory evolution. Requirements continue to evolve, requiring ongoing model enhancement and recalibration. So basically, success requires the strong project management, stakeholder engagement, and phased implementation approaches. So when we think about the credit risk assessment, most organizations focus what's already on the books. But here's the critical insight. Expected credit loss is fundamentally forward-looking. It's not just about measuring the today's exposure, it's about predicting how borrowers will behave tomorrow. And that behavior matters enormously because customers systematically draw down the available credit as they approach default. Now, this isn't academic theory. In practice, this means your CCF models, your EADF frameworks, and your segmentation strategies need to reflect real-world complexity. That's where the technical rigor comes in. Mastering concepts like the small denominator problem separates your junior analyst from your seasoned practitioners. And whether you are building under IFRS 9 or Basel frameworks, understand this. They are solving different problems with fundamentally different modeling philosophies. But the real competitive advantage comes from the practical execution, whether you are modeling term loans, revolving credit, or mortgages. Each product demands its own tailored approach. You need macroeconomic integration, turning static models into dynamic, stress-testable frameworks. And validation isn't optional. Backtesting, bias analysis, and discriminatory power testing aren't just checkboxes. They are your regulatory requirements. So pair that with robust segmentation and conservative overlays, and you have got a defensible framework. So now we have completed a journey through the three foundational pillars of the expected credit loss. Think of them as three critical questions. What's the likelihood a borrower defaults? And if they do default, how much will we lose? And critically, what's their exposure at the moment of default? These aren't just theoretical exercises, they are the DNA of the credit risk measurement. So basically, each component, the probability of default, loss given default, and exposure at default, carries very profound modeling insights. The technical complexity in each one is substantial. But here's what makes this challenging. In isolation, they are incomplete. You can build perfect PD models, perfect LGD models, and perfect EAD models, and still miss the full picture. Have you thought about why? Because these three components, don't exist in a vacuum. They interact with each other. And the real question is, how do they interact? Why isn't ECL simply the mathematical product of these three numbers? What happens when correlation exists between them? And most practically, how do banks actually translate these components into the provisioning decisions? And that's where the missing link becomes critical. And that's precisely what we will be addressing next. So in the next video, we will talk about the ECL formula, which looks very simple. The PD times LGD times EAD, multiply them together and you get your expected loss. The formula here isn't just multiplication. It's correlation structures, portfolio implications, and conditional probabilities, all compressed into three variables. So let's take a real world scenario there, where we'll look at, let's say, a $10 million of exposures becomes a 2.3 million provision under the realistic assumptions. And this gap matters. We'll see that. And it matters differently depending on whether you are reporting IFRS 9 or Basel. Each framework applies these formula in fundamentally different ways, with scenario implications for how you recognize losses and calculate the capital. And here's the insight most modelers miss. PD and EAD, these are inversely correlated. Because when default risk rises, borrowers draw down less credit. That interaction effect is critical. And then you scale from individual facilities to portfolio level, accounting for concentration effects. It's not additive, the maths here gets sophisticated fast. But ultimately, this formula drives real accounting entries and regulatory capital charges. Understanding not just what ECL equals, but how it translates into financial reporting and regulatory compliance. That's the interview mastery. So basically, you are stepping into something special today. The 100 Days of ECL Mastery series. And this isn't just another training program, it's a structured journey designed to take you from foundational concepts all the way through advanced technique in the credit risk modeling to become an expertise. So in the next video, we'll go through these how the PD, LGD and EAD becomes the expected loss with practical examples for better understanding. If question comes to you, why Risk Modeling Hub channel? Because this content is practical and relevant to industry standards. Here I pull insights from actual bank models, Big Four auditors and regulators. The questions we answer are the exact ones that you will face in the interviews at top tier institutions. So if this deep dive added value to your credit risk knowledge, please like, subscribe and share Risk Modeling Hub channel with your colleagues. Every video in this 100 video mastery series is built on the same principle. Accurate, practical, interview-ready content that reflects how credit risk is actually done in the top-tier institutions. Drop any specific EED questions in the comments, whether on modeling techniques, regulatory requirements, or interview preparation, and I'll address them directly to cover them in future videos. So, thanks for watching. Keep mastering these models, and I'll see you in the next video. Thank you.